I'll take you on this video from knowing nothing about ICT Market Makers models to being able to understand it fully and also being able to execute profitable trades using it. This is a full free course on ICT Market Makers Model strategy. This could have been a paid course, but decided to give it for free for the community. All I need from you is to share this video with others to benefit from it. This is just one part of the course, so make sure to watch the other parts. Let's get into it. Okay, guys, so the first thing that we start with in this free course is what is MMXM? So MMXM is an abbreviation of market makers models, and then the X could be either a sell or a buy. So we could be having a market maker sell model or a market makers buy model. In a market makers sell model, we are being bearish and then we enter short positions, the opposite for the market makers buy model. That's what you need to know as of now. What is this abbreviation? Then we can go in details and much deeper into the details of this model, how you can actually utilize and capitalize on this specific setup, which is one of my favorite ICT setups, as well as most of ICT's himself favorite setups. Now, one note before we go into the video is that I'm only going to be explaining and going over the graphs of a buy model. We're going to be discussing a buy model. But if you wanted to understand the sell model, then just do the opposite. Just flip it upside down, and then you have a sell model. But we're going to be focusing on a buy model, not to waste any more time. So MMXM, in this case, market makers buy model, because we're buying here and we're going up from here. We're being bullish. Market makers buy model consists of two curves. So we have the sell side curve and the buy side curve. And each curve has different stages, and each market makers model also consists of some phases. One of those is the original consolidation. So simply, the first thing that we need to identify in a market makers model is the original consolidation. We want to see a range first to be established, to be used later as a liquidity. Now, we're going to be going in details on how to identify this, how to trade it. But before that, I want to give you an introduction or just how the market makers looks like, okay? Now, we first start with the original consolidation. We have a push to the lower side, and then, it's like a range, and then we push lower. We have a range, because we know that price could be either consolidating or trending, right? So we move from a trend to a range, and then a trend or simply an expansion to a range, and then we go lower. Now, this is the sell side of the curve. In this case, we have the original consolidation, distribution, and then redistribution. We could be having different numbers of stages when it comes to distribution. So it doesn't need to be 2, it doesn't need to be 3, any number of stages. And then we come lower. But then when we reach a point of interest, so let's say a fair value gap, breaker block, order block, and then we have a liquidity sweep into that higher time frame PD array, then we can anticipate price maybe go into the upside. Now, before we go into here, and this is called the smart money reversal. This is the zone where we can actually anticipate a change in the state delivery. So instead of having the sell side of the curve, after the smart money reversal happening, then we can anticipate price going up. Our sponsor, Blue Guardian, is the only firm that gives you a tool to protect yourself from hitting your max daily lows and prevent you from over trading. And it is very simple to use. They also have a new unlimited time evaluation with low profit targets and no trading days requirement, so you can get funded in the same day. Blue Guardian is a pro firm that I trust. Use the link in the description below and use the code MOLHAM to get 10% off your next Blue Guardian evaluation. Now, before we go into the buy side curve, what is the importance or significance of the sell side curve? What does it do in this case on a market makers buy model? What it does is it engineers liquidity. Now, as we're coming lower, what do we have? Liquidity created here. So equal highs, we're coming lower. And as we're going lower, what do we created here? Another high, another high. All those highs are created for the future to be taken. So in the future, we're going to be using those liquidity levels to be taken, and mainly the original consolidation. That's where the market makers buy model started. We can enter from here, and that's where it ends after price hitting the original consolidation. So one significance or importance of the sell side curve in this case is to engineer liquidity. Another one, it's simply approaching a point of interest, so a PD array on the higher time frame and a liquidity level. After that, we look for the smart money reversal, and we're going to be going deeply into the original consolidation, what are the different types of original consolidation, and also how to identify and some confluences in order to look for the best smart money reversal in order to spot it accurately. So what we see here is liquidity sweep into a higher time frame point of interest, right? We have the liquidity sweep and the PD array here. And we can see that we're actually going lower until we have the change of state delivery and the market structure shift at this point. So at this point, market structure shift, liquidity sweep here, and also a creation of fair value gap. Now, when we create a fair value gap here, this just tells you a story. And why? Because as we're coming lower, you see we're coming lower. We have fair value gaps here. We have fair value gaps here, but we are not being aligned with the higher time frame. So maybe there is a higher time frame fair value gap here, and then price trade into, create a fair value gap here. So the alignment is to the lower side. The time we get alignment is this higher time frame point of interest going up, or it's actually pushing price higher, and then a bullish fair value gap on the lower time frame. So now we have two things aligning with each other, and that's where we should trade from. So basically, point of interest going up, another fair value gap created going up after breakout structure. That's what we call a low risk buy. So a low risk buy could be right here when we have a creation of fair value gap immediately after the smart money reversal. You could also enter on a change in state delivery. So somewhere in here, you could have actually entered here on a lower time frame. And as we're going up, we have another accumulation phase where we can actually also enter from. So this is the first type of entry, which is the low risk buy. We're going up. We have another breakout structure going up. So this is another liquidity level, and also this is another liquidity level. And you see, before reaching this level, what happened is we come lower. We might have a fair value gap here. And what we see happening is a sweep into a fair value gap or any type of entry, maybe just a fair value gap by itself. But there is an entry here. We can actually enter. So the first type of entry could be here. Second one could be here. And then the reaccumulation entry, again, breakout structure to the upside. We're coming lower, and we have sell side taken here, maybe into a fair value gap or an order block or an old high, which is the overlapping of a high and maybe a fair value gap here. This is ICT's favorite entry. You always talk about the reaccumulation or the redistribution phase on a market maker's buy or sell model. Okay, so sweep here, and then we stop entering when the original consolidation is hit. What is the significance of the buy side curve in this case? Basically, it's creating, rebalancing fair value gaps, and then sweeping liquidity. What we see here is fair value gap, maybe a fair value gap here, and a sweep of liquidity. Again, fair value gap, sweep of liquidity, and going up. And it's also approaching the original consolidation. So you see we have this type of a curve. The sell side is actually engineering liquidity and approaching the PD array, and the buy side is rebalancing, sweeping liquidity, and also approaching what? The original consolidation. So now we know that we're going up. Now, a lot of the time you'll be actually trading this, and maybe sometime you trade this, but you notice sometime that when you enter your trades, sometime you can actually target, for example, if you enter here on the low risk buy, sometime you will notice that you're actually being able to target 5, 6, 7, 10 reward to risk. And sometime you can only target 2R, and then it goes to break even. What is something that you can actually look at or learn in order to always take that 10 reward to risk trade? It's actually market makers model. So if you are able to identify and spot market makers model, you'll be able to only trade the high reward to risk entries and also the high probability, which is going to give you a higher win rate. So if you focus on market makers model and be able to identify them, you'll always take trades somewhere from here, for example. So a trade here and not targeting this, but have a clear target that most of the time, and there is a high probability price reaching it. And this could be 7 to 1, 10 to 1. So that's a big trade that you can actually use or capitalize on in order to pass a funded account, for example. That's what you're going to be able to do after finishing this. Now, we talked about the original consolidation already, right? It's the first phase that we need to identify and look for, but there are different types of original consolidation, right? So it could be in different shapes. The first one could be this one. So we have a range. Now, simply the original consolidation needs to be ranging, but it could be in different types and different shapes. The first one is as price is ranging before price coming lower, because we're having what in this case, a market makers buy model. So we're going to be looking for the smart money reversal all the way down. But before price coming lower, it needed liquidity in order to go lower. So sometime it's not going to go just low like this, right? What it's going to do is sweep liquidity, in this case, a buy side liquidity, and then start coming lower. That's the first type. Second type could be price creating highs and lows, highs and lows, highs and lows. And before breaking out to the lower side, it's going to go to equilibrium of the range. So this is 0, this is 1, and this is 0.5. So the equilibrium of the range, there is an order block or fair value gap, mostly an order block, and price is going to react from it going lower. This is a high probability. This is a high probability, but a higher probability one is this one. So what is the difference between this one and this one? Simply high resistance liquidity run, low resistance liquidity. This one created highs, and then instead of breaking out to the upside, simply we created relative equal highs in this case, and we started going lower. In the future, when we see this like smart money reversal here, that's going to be a very nice target because now we have liquidity here and we have what? More liquidity here. So low resistance liquidity, and that's what we need to actually target. We need to target low resistance liquidity because that's where most of the liquidity is, okay? So this could work, this also could work, but this one is the best one. This is the best or the highest probability original consolidation you can actually focus on.